Good morning and welcome to this Monday, June 14th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, last week was very interesting. We did have a big CPI report came out on Thursday morning. Market kind of yawned, really didn't care about the higher inflation. Headline numbers were very high, 5% for CPI. We hadn't seen that since 2008. Really, you can go back a few decades since we've seen numbers in that range or higher. So the market had every right maybe to be concerned about it. We were definitely concerned in May when the numbers came out, but seems like the market has kind of gotten over the inflation fear. I'm sure there are plenty out there who think that that's a mistake, but I tend to just follow what the market says. And if inflation is a problem and the market believes it's a problem, we're going to see it showing up in the charts. We did not see that last week. So I am going to stick to my very bullish thesis. I think the market goes a lot higher from here. I'm not saying it's going to go up every day. I don't know that it's going to go up over the summer. I just believe long-term, big picture, I think we're going higher, and it's just a matter of timing and how we get there and what leads. So that's kind of the theme as we start this new week. We do have the PPI coming out tomorrow, Tuesday morning. And then, of course, the Fed will be meeting Tuesday and Wednesday. We'll get their latest policy statement Wednesday afternoon at 2 p.m. And so we'll have some more information to trade off of. I really don't think we're going to hear anything new out of the Fed. I think the bond market is giving us the only signal we need right now, which is showing us that yields are dropping again. And that, when I follow the markets, I actually believe the bond market is smarter than the stock market. I tend to follow the bond market pretty closely. I did not expect the 10-year Treasury yield to break down below 1.50%. I didn't. I thought we'd sideways consolidate maybe for a while, but then eventually we'd break out to the upside. Breaking down makes no sense whatsoever if you're on the inflation side. There's no reason for folks to be buying Treasury bonds in an inflationary environment. So I think what that's telling me is that the bond market believes that the inflation concerns are way overblown, that this is a short-term problem. And so that's how I'm approaching the market right now. Now, if the yield all of a sudden with the PPI coming out tomorrow turns around and jumps 20, 30 basis points, then and the different ratios that we like to follow, the IWF versus IWD, growth versus value, if they start to fall apart, then we got something else to consider. But we can only go on what we see, and what I see is a long-term bullish picture. And short-term, I'm starting to see a lot of improvement in areas that shouldn't be improving in an inflationary environment. Let's go ahead and get this thing started. I'm going to take everybody over to Earnings Beats, to our website. We do have our spring special running. Want to mention this is it, last 2 days, today and tomorrow. Tomorrow ends. We've been running this for a couple of weeks, but we only do this once a year. You do get 2 bonus months. So if you click on this, go to our website and you click on the spring special, you'll get an idea of what we offer. But down at the bottom, you'll see we get you get not only 1 bonus month for signing up for an annual, but then you get a spring special second. So you get 2 bonus months. So you get 14 months in all, and the price is $997. Normally, the monthly rate is $147. If you take that times 14 months, it's over $2,000. So you're talking about a 52% savings signing up for a year. So just want to mention that that does end tomorrow, June 15th. Make sure if you're planning to extend your membership, or maybe you're a trial member, you do get the rest of your trial period, by the way. So if you're a 30-day trial member, you're only 2 weeks into your trial and you want to extend, you'll get the next 2 weeks of your trial, and then you'll get 14 months on top of it. If you're not a member of Earnings Beats and you like to try us, this is a great time. Come on in for the next couple of days. We got a big event tomorrow night, by the way, which is open to the public. That's going to be our monthly Max Pain. Normally, that's a members-only event. We are opening it up because of our spring special and everything we've got going. We wanted everyone to get a glimpse of what we do for our Max Pain session. So make sure you check that out. And like I said, if you come in, try us right now. You get 30 days, no cost. You get charged $7 up front. We refund it within a week. So literally no cost for 30 days. And here over the next couple of days, if you really think you like it and you want to stick around, then you've got the spring special to fall back on. All right, moving on. Oh, and by the way, here at the bottom of the homepage, you see the spring special, but if you scroll down, you can sign up for our free newsletter. If you're not a part of our community at all, you want to sign up for this free newsletter, because tomorrow we're going to be sending out our room instructions. So we send it, it's a free event, but you do have to be part of our Earnings Beats Digest community in order to get the room so that you can come in for the event. This does not require a credit card. You can unsubscribe at any time. It goes out 3 times a week, Mondays, Wednesdays, Fridays. And all you need really is your name, email address, and hit that subscribe button. All right, let's go ahead and move on. Take a look at what happened on Friday. The Dow Jones Industrial Average up 13, S&P up 8, new record. The NASDAQ up 49. NASDAQ not far from a record. Growth stock starting to return. We're going to talk about more of that in just a bit. Mid caps up 21, not far from a breakout there. And small caps, after pulling back for a few days, did rebound on Friday, up 13.5 points, almost 1%. That was your leading index among our major indices. In the sector area, financials led up 2/3 of 1%. That group had been beaten down most of last week because of the falling treasury yields. Technology going the opposite direction. We're starting to see leadership again in technology. That's very bullish. Consumer discretionary definitely had a better week last week, but you can see still below the 50-day moving average. Got a little work to do. I think a move through about 175 would be pretty bullish on the XLY. We closed at 173.21 on Friday. Healthcare made the breakout last week, pulled back. I think this group, and we talked about this a little over a week ago, when it was down to 50-day moving average, I was mentioning, and I thought it was one of the better reward to risk areas of the market, just because it had pulled back and because June historically has been a very good month for healthcare. And so healthcare getting off to that seasonal good start here in June. Pulled back on Friday, though, was the worst performing group on Friday. Real estate also struggled on Friday. I wrote maybe earlier last week about real estate, just thinking it was getting a little toppy looking at the 60-minute chart. So I'm not surprised we saw a little weakness on Friday. I think we could see a little bit more weakness in real estate. I would be looking for a 20-day test at a minimum. All right, moving on to the 10-year Treasury yield. So let's get an update here, see what's going on. And this is what I was talking about earlier. Just did not see this one coming. Didn't see it moving back below 150. I figured even if the inflation numbers were tame, which they were not, but even if inflation numbers were tame, I was thinking, okay, the economy is going to be strong enough where you're not going to want to rush into bonds. But when we got the non-farm payrolls out a little over a week ago, and they were not as high as expected, and I think the market is simply ignoring the short-term inflation spike. I think that combination is what saw this breakdown. If we see this yield keep going down, technology is going to really push to the upside, in my opinion. We're going to see, we've already seen pretty good movement in many technology areas, but I think that is going to accelerate if you see this 10-year Treasury yield continuing to move lower. Today it is up about 1 basis point, 1.47%. Nothing out in terms of economic news, but that will change tomorrow. As I mentioned, PPI is coming out tomorrow. Retail sales comes out tomorrow. Industrial production capacity utilization, that comes out tomorrow. And there may be another report or two that I'm not thinking about right now. But there's quite a bit that will be out tomorrow. So there's going to be a lot for bond investors to trade off of, as well as stock investors. All right, moving on to talking technically. Well, here is the IWF IWD. And I go over this a lot, but honestly, I look at this a lot throughout the day. I look at it on intraday chart. I'm constantly looking to see what growth is doing relative to value. I wouldn't normally do this, throughout, just a regular bull market advance. But the rotation has been so severe in the market over the past several months that I think you really have to keep an eye on this. When growth was outperforming value, you didn't want to touch value and you wanted to be all over the growth stocks. And then as we rolled into the end of 2020 and into the beginning of 2021, you can see that really started to roll over. And it was in February that we broke down below 1.70, 1.69, right in that area. And notice when we made that first run up, this was back in April, you can see we got right back to 1.69, couldn't get through, and then we rolled over, and so far have printed a double bottom. So I think we're between about I'm going to say 155, maybe even give it down to 154 over here. But I'm going to say 154 to 169 is the current range. And we're at 162. So we're right in the middle of it. But we do have this double bottom in. So if we can go back up and get through 169, then I think the worst is behind us in terms of growth stocks. As long as we stay in this range, this could be a range that we're in for the summer. I mean, I don't know. We'll have to watch to see whether we get the breakout to the upside or whether we roll back over again. That's a possibility. You know, right now I'm saying market's not caring about inflation, but market sends us head fakes all the time. Maybe with the PPI coming out, or maybe over the summer, things continue to heat up in terms of many of the material costs and so forth. And maybe inflation does become a problem. And, you know, just recognize we are still in this downtrend on growth versus value. Now I break it down even further. Now this is a 3-month, 60-minute chart on the IWF on IWD. And you can see right now, we are moving up. And I loved this breakout above the late May high because we've gotten all this CPI data and we got PPI, and the April PPI came out in mid-May. And now that's getting ready to come out. The May PPI is getting ready to come out tomorrow morning. And with this, we're actually trending higher. As long as this moves higher and the 20 continues to move up and the 50 underneath, this configuration right here, you want to be in growth. Now, you got to be fairly nimble as a trader, because if this starts to roll back over again and break down, you're going to want to be back out of growth. So this isn't a situation where I would say, hey, just jump into growth and look in a few months. That could be a big mistake because, again, you go back to that daily chart, and we've been in this downtrend. We haven't broken the downtrend yet on the daily chart. The relative PPO, you can see right at the 0 line. So this is kind of an area where it's going to be very interesting to see where we go from here. But anyway, there's your short-term hourly chart. Let's see, what else do we want to talk about this morning? Well, let's take a look at some of the relative groups. So this is from the last week, and this is our industry group relative strength chart list. And this is available to all annual members. Any annual member can download this right into their stock charts account, as long as you're an extra or a pro member. But what I like to do is just pull this up in summary form. So if you're just out here looking at the S&P 500, to get to this, what you would do is find your chart list wherever you have it located in your own account. And then once you pull it up, go into view all and hit summary. Now it'll come up intraday. So you go over here to the period, change it to whatever you want. I'm going to go with 1 week. And you can see renewable energy, biotechs, transportation services, media agencies, and broadline retail software. I mean, look at some of these groups: renewable energy, broadline retail, software. Those are 3 areas that were leading during the pandemic. And last week, they had a really good week with, as I said, technology bounced. The growth stocks were doing well. And you can kind of see that coming through in the 1 week relative performance of the industry groups. So I'm going to focus on renewable energy, broadline retail, and software, and just take a look at those 3 charts real quick here. So you've got renewable energy, which is now trending above its 20-day, and you can see its daily PPO is now positive. We had not seen that for a few months during this downtrend. So at least in the short term, renewable energy is starting to strengthen. Whether or not we can hold that as we go forward remains to be seen. But hey, short term, it's trading the way you want from a bullish perspective. Then we take a look at the broadline retail. And broadline retail also moving up to about a 5-week high, back above both its moving averages. Now, it's been going sideways for a while. We have to respect that resistance up around the 35.50 area. but we've still got another 120 points to get there. So you're talking four percentage points roughly to get to that key high. And it does look like PPO is starting to rise. So I'd say momentum is back on the side of this group. And then the last one I wanted to show you was software. And you can see software right on the cusp of a breakout. Now, while the group was consolidating, software wasn't a great place to be. But when software breaks out, it becomes a much stronger area to consider for trading. So I like what's going on with software. I like this move up above the 20. We came down briefly, went below, and then right back up again. That PPO is rising. What I would like to see is maybe hesitation here, pull back, hit that 20, and then break out. Now, again, that would be what I would like to see. Whether or not that actually happens is probably another story. Market's never that easy. Moving on to some of the stocks within these three groups. One stock in the renewable energy space that I like is Enphase Energy. This is one of our portfolio stocks. Made a big move, very, very strong move here with increasing volume back in mid-May to get above its 20-day. Came back down just briefly, and now it's breaking back to a new high. It does have a lot of gap resistance. The bottom at 150, the top near 170. So that's going to be the zone, but I think we're going to go and trade into that area, and then we'll see. I mean, breaking out eventually above 175, I think will send this stock back up to its highs. But in the short term, watch the 20-day to the downside and this area of gap resistance to the upside. In the broadline retail area, you've got to look at Amazon. Amazon, I think, looks real strong right now. Nice move up here, breaking back up above these recent highs. And when we've done that in the past, you can see these recent highs in March, you break up, look at that move to the upside. Now here we had a couple, we broke out for 2 days and then we failed. So from a trading perspective, I don't mind going back down to 3,300, but I'm not going to be looking for a close below 3,300. So for me, I would keep a fairly tight stop on any close back below that 3,300 level, or at least maybe below the 50-day. Or both, the combination. But outside of that, outside of a pullback and a close below that level, I would expect this to run. Now, Amazon, like many of the growth stocks, probably going to be in some trouble. If the inflation trade kicks back in again. This is a growth stock. Growth stocks do not do well if inflation is a problem. So that's why it's so important to kind of watch these other charts that can be giving us clues as to how the market is approaching, or how professionals are approaching the market in terms of, are they, investing in the areas that'll do well during an inflationary period, or are they returning back into that growth environment, because growth would not do well in a high inflation area or period. All right. And then you've got areas like software. Adobe is going to be reporting later this week, and Adobe made a nice breakout last week. I love this breakout here. Volume picking up. We could go out a little bit further here. Let's go out a couple of years so we get through that whole pandemic era. But you can see this breakout is taking out that September high. And I don't know if you recall, but I wrote an article back at the beginning of September when growth stocks, many growth stocks topped. I mean, we saw Amazon top there. Here's Adobe topping there. Many stocks topped back in that area. I don't remember when Zoom topped, but I think Zoom topped probably pretty close to that time frame as well. There were a lot of overhead issues in the market back then, a lot of areas that were telling me to be cautious. And, you never know whether or not that's a long-term signal or a short-term signal, but it is a signal nonetheless. But many of these growth stocks have struggled. But now we're starting to see one by one really beginning to pick back up again. You can see Adobe. I showed you Enphase, Amazon breaking above a recent high. Zoom, I talk about a lot. I own Zoom. Zoom making this move back up through its moving averages, starting to trend, looks like trend higher above its moving averages. And this one didn't top in September. It actually topped in October. But this was one that had made a huge run. And when you get a stock that makes this big of a run, we're talking about $60 to $600 in less than a year. Sometimes it takes a while because the fundamentals have to catch up and the technicals kind of pull back and they kind of meet in the middle somewhere, and then you start to see things strengthen again. I think that's what's going on here with Zoom. Let's see, what else do we have? Got to talk a little bit about crude oil. I mentioned this pattern that crude oil was in. Had a big move up, nice little cup here, handle, or you could look at this as a ascending triangle, which is what I think I had written about. Let me show you the triangle here. So what we had was equal highs coming across, and then higher lows. So, I mean, if you think about it, it's like, you know, if you were going to try to work your way through a door or something that was locked, you know, you wanted to break the door down, you take a running start, hopefully do a little damage to the door, probably do more damage to your shoulder, but do a little damage to the door. You might not have to run back as far because you've already started to create a little bit of, you know, a crack, if you will, in the foundation of that door. And so you just keep going back up and hitting the door, and then you pull back, you don't pull back as far, and then eventually you break through the door. And that's kind of what an ascending triangle is. You see equal highs coming across. It's an ABCDE pattern. A is the first high. So you're soaring along. Everything looks great. Sometimes in this case, you can see higher prices, lower PPO. So we had a negative divergence. It told us there was slowing momentum. And so we pull back to the 50-day. And at this point, this is when I began looking for continuation patterns, because I believe we're in a secular bull market. You had a nice advance. Now we're consolidating. Is it going to be a cup? Is it going to sideways consolidate? What's going to happen here? Well, that was point A. We come down, we establish that first low in this pattern. That's B. Come back up, you test the high, that's C. You pull back one more time to create that higher low. That's D, and then you get the breakout. Now, from the measurement perspective, and that's why I like patterns, is it gives me an initial measurement, 67 down to 57, that's 10 points. When you break out above 67, you add 10, you get the 77. That's my measurement on crude oil. Now, the interesting part about this measurement, as I went on to point out in, I think it was in a daily market report I talked about, it may have been a blog article. The interesting part is when you look at the long-term chart, a couple of things I want to point out here. On a long-term chart, you can see that after falling apart back in 2014 through 2016 in crude oil, I mean, we dropped from $120 or $110 a barrel down to 27. On that reaction high, where did we go? $77 a barrel. So here we are with a short-term measurement on the daily chart measuring to 77, and that just so happens to be the key area of resistance. So I think we're going to 77. We were up another 1% today. This doesn't show today's action. This is as of Friday's close. But crude oil is up another 1%. I think it's 71.60 or something like that a barrel. Now, the other part of this chart that I wanted you to look at was the correlation, because this is a 20-year chart of crude oil. Down at the bottom is a correlation between crude oil and the S&P 500. So in other words, is there any correlation between crude oil prices moving up versus the S&P? Does the S&P move up with crude oil? Does it move against crude oil? You know, some might think, oh, crude oil prices are going higher. That means higher costs for consumers. That's bad for stocks. You know, bad for the consumer, so it must be bad for stocks. That's not the case. If you look down here, you'll see over the last 20 years, we spend most of our time in positive correlation territory, meaning that the S&P 500 has a tendency to do what oil prices do over 20-week periods. So here you can see for the last 12 years, we spent most of our time in positive territory with just a few periods of inverse correlation. So it's not perfect positive correlation, but we should think bullish thoughts with the crude oil prices going higher, simply because we've got positive correlation for the most part between crude oil and the S&P 500. So this is just one of those signals. I'm not going to say, hey, just follow crude oil, and if crude oil is going up, S&P goes up. If crude oil goes down, the opposite. It's not what I'm saying at all. Stock market held up okay from 2014 to 2016. We had some volatility. We went sideways, but we didn't go down like the crude oil prices. So I wouldn't be, looking at it from that standpoint. It's just one of the pieces of the puzzle. Crude oil prices going up tells me there's demand. And if there's demand, that usually is a good sign that our economy is in better position. And if our economy is in better position, many of these S&P 500 companies, their earnings are going to grow. And so that's why we see this correlation. All right, I wanted to show you a scan that we just updated. I updated our strong earnings chart list, strong future earnings chart list, raised guidance chart list, and our short squeeze chart list. All were updated yesterday. So if you're a member, you can go to earningsbeats.com and you can go into the member area and go over to chart lists and scroll down. Here's the strong earnings chart list. All you got to do, if you're a new member, you're not sure how you do this, or if you're maybe going to try our service, you go in here and you type, you grab this password. I just hit, just click and save it, copy it. And then you go into this link. Now I've already downloaded this into this account, so it's not going to ask me for my password. But normally when you click this link, it'll ask you for a password. And that one I just copied, you then paste it where it's asked, and then you click OK, and then it brings you to this page. And now, if you're not a member, this is what you would get to see, probably with ads, because if you're not a member at Stock Charts, there are probably going to be ads on this page. But you can go through and you can look at all the charts. Now, on this particular chart list, there's 690 charts, I think. So it'd be a long time to go through 690 charts individually. But what you can do as a Stock Charts member, extra or above, is save the chart list. And when you go in here, then if you've already been a member and you already had a prior strong earnings chart list, you just go in here and hit replace list, and then hit strong earnings or whatever you're calling it in your chart list, and then hit save results. It'll automatically update. It erases what you had before and completely updates it with what is currently in the strong earnings chart list that we have. So if you don't want to replace the list, you can always put it in a new list if you want to keep the old. Anyhow, just wanted to point that out because that is a very cool feature at at Earnings Beats, combining with a Stock Charts membership. Now, once you've downloaded these accounts, this is a cool scan to run, and one that I like to run. I like to know what companies beat earnings, beat revenues in their last quarterly report, and also raise their guidance. And the way you can do that using our platform is just simply go down and get the two chart lists. So you go down, you grab strong earnings chart list, add. So that's now up here. And then go down and grab the raised guidance chart list, add. Now, if you notice, it says favorites list, blah, 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 blah. That is particular to my account at Stock Charts. So if you type this in, your account is going to look for your chart, your favorite list number 155. It's not going to be looking for my favorite list 155. So you've got to make sure you're grabbing the chart lists that are in your account. I've had members write in and ask and say, well, I copied your, the scan that you indicated, but I wasn't able to pull up, didn't return anything. Well, it's probably because maybe you don't have anything in these two chart lists, or if you do, you don't have the same tickers in the two chart lists. But you want to make sure that you're grabbing your own chart list. So all you do, start with a blank scan criteria, and then come down here and just grab the chart list. So when I run this, it's going to tell me which charts are in both of these lists. So I'm going to run it, and I've got 220 companies. So while there's 690 or whatever in the strong earnings chart list, there's probably another 550 or whatever in the raised guidance chart list. There are 220 that are in both. And so you could literally take this list and drop this into a new chart list. And, well, actually, let's cancel that. I can put this, replace an existing chart list. I can just go in and put it in one of my scan results. So I'll just drop it into scan results other. But you can call it whatever you want, and then you can just drop it right in. Now you've got a chart list of the best, in my opinion, raising guidance in addition to beating the last quarter. These are going to be some good momentum stocks, in my opinion, to consider. Then the next thing you could do is add the column for the sector, industry, and scooter. And even sort it by scooter rank. These will give you the best relative strength stocks in this list. I mean, you start looking at some of these stocks, CLF, I know Crocs has been amazing, Generac starting to pick up, but look at Cliff, just made a recent breakout, nice breakout there. So that's some of the things you can do with our platform once you have it in place and you have our chart lists. All right, it is 9:30. Let's take a quick look. I mean, from an earnings, I'll tell you, we'll combine earnings spotlight and the 3 you must see, because there are no earnings out today, but there are 3 pretty good reports coming out later this week that I think maybe everyone should be interested in seeing how they do. Oracle is now one of the leading software stocks. So, whoops, that's not the chart I wanted. So if you look at Oracle and you look at it relative to the software group, I mean, it's gone from a 52-week relative low to a 52-week relative high in the last 90 days. Oracle is absolutely being accumulated. Look at the AD line last 2 or 3 months, moving up. So this is a stock I think that in the institutions have been accumulating and I think continues to perform well. They report tomorrow though. So my expectation is that they're going to have a strong report, but that's just my expectation. Next, Lennar, LEN. Home builders really struggling right now. And I'm wondering if the yield coming back down starts to maybe, light a fire under the group, because we had an uptrend. We could have a left shoulder neckline, a lower low puts in a head. If we can get back through that 20-day and back to the 100 level, I think that would be a bullish signal here on Lennar from a longer term perspective. If it fails at the 20 and then turns back and prints a new low, then I would certainly be out of this stock and probably out of the group. Lennar reports on Wednesday, so that'll be an interesting report to follow. I mentioned Adobe earlier, so I won't talk about that one. Adobe reports on Thursday, but how about Jabil Circuits? Used to be Circuits, it's now just Jabil or Jabil. I'm not even sure how you pronounce it. But JBL really performing well. The relative strength versus its peers, 52-week high. This is a stock that should do well, but it's already made a good move. So this is the type of stock, if it comes out with really good earnings, but gaps down, that might present a nice opportunity to get in on the gap down. I'd be watching probably around that 50-day moving average on any pullback. All right, that is it for me. Let's see what the market is doing to open up this new week. We've got Dow down 63, S&P down 5, NASDAQ down 6. It'll be very interesting to see how the market responds with another big inflation report out tomorrow, the May PPI. Fed, I think we're probably just going to, I usually look on a chart for a spot for the market to gravitate to, kind of a key area, because that's usually where the S&P seems to gravitate to heading into a Fed meeting. If there's just one spot on the chart that you think, man, this is the key level that I'm really interested in, don't be surprised if that's where the S&P is sitting when the Fed reports on Tuesday. All right, that's it for me. I want to thank everybody for tuning in. Again, a reminder, go over to Earnings Beats. If you haven't already signed up, make sure you go to our homepage and go down, scroll down, and subscribe to our newsletter, because tomorrow morning we will send out instructions for joining us in that free Max Pain event. If you haven't been to one of these, I think they're amazing. We talk about market makers and what would be in their best interest financially in terms of some of these stocks that are heavily traded in options. You need to know where the key points are in the options world, because many times market makers will direct prices toward those areas. I call it Max Pain. And anyhow, it'll be a great event, but you do need to be an EB Digest subscriber. Free, no credit card, and you can unsubscribe at any time, but you do need to be a part of this to get access to the room for tomorrow. All right, that's it for me. Again, have a great day, everybody. I'll be back tomorrow over at Stock Charts TV for your next episode of Trading Places Live. That'll start at 9 a.m. Eastern. Hope to see you there. Have a great day. Happy trading.